Okay, everyone, I'm really excited. Today we have Al Caporale with 1031 Exchange. He is the president and CEO of Exchange Authority, and he has done many thousands, three, four plus thousand 1031 exchanges. So I'm very excited to chat with you today, Al. Thanks for coming on. Do you think you could just maybe to start? I always like to start off by kind of just like understanding how my guests got into the place that they are. I mean, I think like the 1031 exchange world feels like a very like niche down world, and so like I'm very curious. Like I'm guessing when you were a little kid, you weren't like I'm gonna be the 1031 guy. So I'm just curious to know like how you ended up in this world.
Right. Yeah, and thanks for having me on. Yeah, definitely not when I was a kid did I think I was going to do 1031 exchanges for a career. So, how I got into it is I'm an attorney, I'm licensed in the state of Connecticut. And when I was in law school, I did a concentration in tax law. So, a concentration is kind of like a major.
Mm-hmm.
And shortly out of law school, I think I was maybe 2 years out of law school. I was still trying to kind of find the career that I wanted to go into, and I actually I applied for a job at a qualified intermediary,
Mm-hmm.
got it, started working there, and I kind of enjoyed the work, and I worked my way up from there. And I think I'm now like 13 or so years into the career, and it's just something I really found that I enjoy doing. It is certainly kind of a small niche, but I think there's some nice things to it. You're constantly running into kind of little different scenarios that kind of keep things interesting. And at the end of the day, we're kind of helping people save money, saving money on taxes. So it's kind of generally people are pretty happy about it. So there's kind of that nice aspect to it as well.
Yeah, that makes sense. Cool. And I think like for today's every episode's a little different. I think for this one, if it's okay with you, I had a lot of questions from a lot of owners just over the years that I kind of put together and just like polling, a lot of different multifamily owners as well as condo investor owners around Cambridge, Somerville, and surrounding towns. So I was kind of hoping to be a little more tactical with this episode and ask like some particular questions. And I would just add the caveat kind of before we get into it that like of course, for each individual case, they should talk with a CPA. They should do their own due diligence. We're kind of talking more in a general sense here, and that you need to talk to your CPA and do your homework here. And you can't just take this podcast and say, okay, this is it. Is that fair to say?
That's
Um,
absolutely fair to say. That's a great caveat to add there.
yeah, for sure. Okay, cool. And so maybe before we kind of get into the tactical stuff, just high level for listeners who have heard 1031s or maybe have never heard that term, but they don't really know it. Can you just kind of talk the specifics, like what is the timeline? What is the point of this? Just high level what it is for someone who doesn't know much about this.
Yeah, so in a very broad sense, a 1031 exchange is a way to sell a piece of it's a transaction where you can sell a piece of investment property, and by reinvesting the funds into a replacement piece of investment property, you're allowed to defer the capital gains tax from the sale of a property. So there's a whole host of benefits that somebody can derive by doing a 1031 exchange. Mechanically, how it works is it starts. There are multiple different types of 1031 exchanges. I'll kind of introduce with kind of the most prominent one or the most commonly done and kind of the easiest one to kind of start off, which would be what's known as a forward 1031 exchange. In a forward 1031 exchange, everything starts running from the date of sale, closing of the sale of what we would refer to as the relinquished property. That's the property that the person doing the transaction currently owns and they're planning on selling. Um, First and foremost, they have to enter into the 1031 exchange prior to the sale of that property. That's incredibly important. Unfortunately, that's kind of a call I get on a regular basis. Somebody says, oh, I sold my property a week ago, a month ago, and I want to do a 1031 exchange. Unfortunately, if you don't enter into the exchange prior to the sale, it's too late. So that's very important for anybody who's considering this to know. You really need to kind of get your ducks in a row before closing of the sale.
Mm-hmm.
Um, from the date of sale, the person doing the transaction has 180 days, or excuse me, I'll start with the 45-day time period, has 45 days to identify the potential properties that they wish to purchase. And there are limits on the number of properties that they can identify. Once they've identified properties within that 45-day time period, that list is set in stone, so there's no ability to modify the identification following the 45-day time period. And then in order to complete the transaction, they have to acquire one or more of the properties that they've identified within 180 days. And that does start running. So the 45-day time period and the 180-day time period do run concurrently. So it's not 45 and then 180. It is 45 inclusive, or 180 inclusive of that 45.
Got it. Yeah, and it's like it's 45, 180. It's not like you get a break if it's not like business days only. There's not like a break for holidays. It's just 45 days straight through, 180 days straight through for those listening, right?
Yeah, correct. It does not go by business days. It goes by calendar days. So if if you're doing a 1031 exchange and your 45th or 180th day does fall on a Saturday, Sunday, or holiday, you don't get till the following business day. So you want to make sure that either you've gotten that identification in or you've closed on that property, prior to that day. If it's a holiday, for example, you're not going to be able to close generally on a holiday. So you got to make sure you get it done on the previous, the last business day that you have.
Mm-hmm. And we've done a number of deals together with my clients, and we've had excellent outcomes. And like you said, there's just tremendous savings when it comes to capital gains as well as depreciation recapture, especially for those clients who've owned a property for a long time. That's one that a lot of landlords are not familiar with. But in the end, it can be, we're talking 30, 40+% sometimes in terms of savings. So it's really tremendous. I think that talking to a lot of clients, what often comes up is they say, whoa, 45 days, that's not a long time. 180 days, if I don't find the right property, like I don't want to feel like I have a gun to my head. When I found my last property, I had years to look for the perfect property. And so I think that scares some clients off, despite I think with proper planning, it can totally be done. And I pull it off all the time. And the fact that you've done 3,000 to 4,000 plus of these shows that it can work. But I think one thing that gets a lot of clients excited is when they hear about a much lesser used one, which is the reverse exchange. Are you able to talk a little bit about how the reverse exchange works in terms of the process, and then maybe a little bit about why don't more people do it? Because on the surface, you hear a reverse exchange and everyone says, well, of course I want to do that. I could just buy the property first. I can take as much time as I need. It's much easier for me to sell. So can you kind of break down how the reverse exchange works and maybe a little bit about why a lot of people end up not going that route maybe?
Yeah, and that's a great point. I think the 45-day kind of a question I get asked a lot is, well, what's my biggest challenge going to be in doing a 1031 exchange? Mm-hmm. And for sure, kind of the biggest challenge generally is that 45-day time period. Kind of one of the biggest pieces of advice I like to give, I give to every single client. Usually I'm fortunate enough to kind of speak to them earlier on in the process. And I always say, if you're waiting for your closing to occur on your sale, go out, be looking for properties. So it's really about putting in that due diligence, in that work, making sure you're out there looking at properties, because the 45-day time period starts running from the date of closing of the sale. So you have all that time before that closing while maybe your property is listed or you're under contract to go out and try and find the replacement property you want to purchase. So on a forward exchange, that's certainly a strategy I try and kind of encourage my clients to
Sorry to jump in, but like to your point, like oftentimes when I'm working with clients, what we'll actually do is get a property under agreement first to buy, and then we just time it such that the sold property sells first, and then they close on that property that's under agreement afterwards, and that makes it relatively clean a lot of times and with less stress too.
Yeah, absolutely. That's a great strategy to use to allow somebody to kind of take their time finding the replacement property they want and still utilize a forward 1031 exchange. To your original question, a reverse exchange, kind of as the name implies, is a 1031 exchange where the exchanger, the person doing the transaction, acquires the replacement property prior to the point in time that they've sold the relinquished property. How it works is they are not allowed to own title or hold title to both properties at the same time. And so, kind of said another way, they can't acquire the replacement property and own the replacement property while they still own the relinquished property. So what has to happen in order to prevent that from occurring is the qualified intermediary has to step in and hold title to one of the properties. We refer to that as parking one of the properties. And kind of at a high level how that works, the qualified intermediary will create an LLC, a special purpose entity specifically for holding title to one of those properties. Now, reverse exchanges can be done in two different ways. They're sometimes referred to as a replacement parked or relinquished parked, or exchange first versus exchange last. And the difference between those transactions is just which property the qualified intermediary is going to park and hold on to. The preferred method and kind of the predominantly used method is the replacement parked or the exchange last transaction, where at the closing of the purchase, the qualified intermediary acquires title to the property being purchased. And then the qualified intermediary holds title to that property, leases the property back to the exchanger so they can kind of operate that property as if they would normally if they had acquired it. And the same time periods that apply to a forward exchange also apply to a reverse exchange. Generally speaking, they're going to know what property, in order to do a reverse exchange, they have to know what property they're buying. So that kind of eliminates that concern. And most often they know which property they're selling to take part in the reverse 1031 exchange. So the 45-day time period is less of an issue in reverse exchanges. The main kind of concern there is that they have to sell their property within 180 days in a replacement parked exchange from the date the qualified intermediary acquires title to the replacement property, which is going to be the closing date of the purchase of the replacement property. So kind of just focus on the timeline. Exchanger enters into a contract for the purchase of the replacement property. They're not going to be able to sell their property in time. They engage a qualified intermediary. At the closing of the purchase, the qualified intermediary parks title to the replacement property. From that date, they have 180 days to sell their relinquished property, and the qualified intermediary has to transfer the replacement property back to them, all within that 180-day time period.
Got it. And in terms of why these, because on the surface, I think a lot of landlords hear this and they're like, well, I'm going to just do the reverse exchange, Can you kind of talk through some of the reasons why it turns out that most people do the forward exchange and not go, and I have seen people do the reverse, but why it is that maybe it's a little more complicated? I think it's more expensive, first of all, right?
Yeah. And just to give you an idea, I think it's probably somewhere between, only 5 to 10% of exchanges, roughly are reverse exchanges versus forward exchanges. I think you touched on one of the bigger ones. It is quite a bit more costly to do a reverse exchange. Also, it's much more complex. A forward exchange really does not add much, if any, complexity to your typical real estate closing. However, that's not the case with a reverse exchange. A reverse exchange is much more complex, and sometimes people kind of, I'll have conversations with people explaining the process of a reverse exchange, and they'll just say, that's too much for me. I don't.
Your eyes start glazing over with all the details. Yeah, exactly.
Yeah. And then also probably the biggest challenge, let's say people can get past the cost and they can get past the complexity. The biggest challenge is financing on a reverse exchange. Yeah. If it's a cash purchase, then that's not an issue at all. However, the challenge with the reverse exchange and the financing is, a traditional forward exchange, it's easy. They sell their relinquished property, they pull their equity out, they now have that equity that they can then use to put down on their purchase. In a reverse exchange scenario, they haven't accessed that equity yet from the property they're selling. So if they have to get traditional financing for the purchase, it's more challenging, particularly if you're talking about residential properties, because the qualified intermediary is going to be on title to the property, but really the person the bank is lending to is not owning the property at the time of the purchase. And particularly in commercial, there's more flexibility, and lenders are typically more willing to lend in a reverse exchange scenario. It is more challenging in a residential, kind of residential loan to have them allow that type of transaction.
Yeah, I mean, it sounds like to me, and just talking to a lot of owners, it seems like for a typical mom pop owner that maybe owns one or two multifamilies, most of the time the reverse exchange probably isn't going to make sense. If you have a bunch of multifamilies and you have a bigger portfolio, there's probably a way and you've owned them for a while. There's usually kind of ways to make it work. I have found personally, but I don't know if that sounds right to you.
Yeah, absolutely. And I think
Generally speaking.
somebody who owns multiple properties, I think they have a little bit, because they have alternate forms of financing. They can use another property as collateral to pull money out, so they can kind of make it a de facto cash purchase. So they have other avenues they can go down. Typically, a lot of times what we found too is, somebody who owns a lot of properties, they tend to have more relationships with lenders and stronger relationships. So, we had a client who, one particular bank held mortgages on a number of their properties. So when they proposed the reverse structure, the lender was like, sure, we've worked with you for so long, we're comfortable with you, we have no problem with it. Whereas if it's kind of just a one-off and the lender's working with you, they might not kind of have that leeway there.
That makes a lot of sense. Okay, so to sort of pivot a little bit. So this is another question I've had over the years. A lot of times when someone's calling me about potentially selling their property, multifamily or any investment property, and we get to the 1031 conversation, like one thing that comes up is one of the reasons people sell is they go through a divorce. It's unfortunate, but it does happen quite a bit. And the couple owns the property together, and they say, well, we want a 1031 because we just talked to our accountant and we looked at that tax bill. We really want to avoid it and find a way to make this work. Is that possible? What do you recommend? Are there different ways to approach this? Can you talk a little bit about that scenario?
Yeah, so it's absolutely possible to do a 1031 exchange in a divorce. And honestly, it's really no different than any other 1031 exchange where there's joint ownership. So one of the nice things about a 1031 exchange is it does, when spouses own the property, they're typically, although this isn't universal, typically owning it in joint ownership. And that allows each spouse to either take their cash. Let's say you have, spouse A and spouse B. Oh, well, spouse A wants to just take the cash, pay the tax on it, and do whatever else with the money. And spouse B says, well, I don't want to lose the money to the tax, so I'll do a 1031 exchange. And they can certainly do that. They have the option to do that as part of a 1031 exchange. And it's really no different than any other 1031 exchange. Kind of one of the things you will commonly see in a divorce is maybe one of the spouses will transfer their interest in the property as part of the divorce to the other spouse. And kind of one of the not related to 1031 exchange, but under Section 1041 of the Internal Revenue Code, that generally speaking, that transfer from one spouse to the other incident to divorce is not going to be subject to tax. So that kind of allows them to kind of separate their assets from each other, or kind of divide up their assets without having to worry about the tax consequences. And then you add the 1031 exchange into it, and they could say, well, we have this property because we were managing it together, or whatever the circumstances may have been. But, rather than a multifamily, now that I own it, I would rather have a property on the Cape that I use as a short-term rental property. And a 1031 exchange can allow them to do that without having to, pay the capital gains tax.
Okay, that's really helpful because I get that question a lot. Another question I get a lot is a lot of people get excited about 1031s and say, wait, this is awesome. I can just keep upgrading and trading up really quickly over and over again. And so I think one question that comes up is, okay, Sage, you're going to help me find this great under market deal. I want to go in, I want to update it, I want to get another 500-600K in equity, and then we'll upgrade and we'll just keep doing it. And in 5-6 years, we're going to have, a $30 million portfolio. Now, what are the limitations around how quickly after you buy a property that you can then do a 1031 exchange into the next property? Is this well defined? Is this a gray area? Can you talk a bit about that?
Yeah, that's a great question. one of the kind of the key characteristics of a 1031 exchange, or key requirements, probably a better way to say it, is that the property being exchanged has to be held for investment. Now, there is not really a bright line rule as to what qualifies as held for investment, although I think a lot of people will use 2 years as that bright line rule. And that 2 year requirement comes in a couple of regulations for specific circumstances, but it does not apply broadly across all 1031 exchanges. So, generally speaking, you have to have the intent to hold the property for investment. And the easiest, kind of one of the easier ways to show that intent is you can hold the property for 2+ years. If you've held it for 2+ years and it's been used as an investment property, it kind of eliminates any question. I think any shorter time period, you do get into a little bit of a gray area where they're going to look at the facts and circumstances of your particular situation to determine if the property is held for investment. And that holding period under the right facts can actually be quite short. One example I use to kind of to show a situation where that might be the case is, let's say you recently purchased an investment property. Your intent the entire time has been to rent that property out. Let's say it's just a 2-family or something. And for whatever reason, you're getting the property ready. You've reached out to a broker to list the property for rental to try and find tenants to put into the property. And unsolicited, you get somebody knocks on your door and says, "Oh, I really saw that property you just purchased, and for whatever reason, I think it would be great in my portfolio, and I'm willing to, offer you a great return if you sell it to me because for whatever reason, I want that property."
Okay.
I think in those circumstances, you bought the property with the intent to rent it. You've taken all the steps necessary to rent it out. Even if you do ultimately make the business decision to sell it at that point, even if you haven't held it for that 2-year time period, I think, in my opinion, that still qualifies as an investment property. In other than kind of 2 situations, there's really not a bright line rule. I think after 2 years, you're very safe. But I think if your facts support that you acquired the property with the intent to hold it for investment, then you can do a 1031 exchange, even if you've held it for less than 2 years. Okay. And I can go into the 2 scenarios where there is kind of an express 2-year time period discussed in the regulations.
Yeah.
And the first one is kind of the vacation and second homes. This one's, very important to people. In what it says is a property will qualify as investment property if it has kind of incidental personal use, and they define that incidental personal use for a 2-year time period. So for each 2 12-month periods following the purchase on a new property or previous to a sale on a relinquished property, it must be used no more than 2 weeks a year, or 10% of the time it's rented, whichever is greater, and it's got to be rented for 2 weeks a year for each of those 2 12-month periods. So that's one of the places where you see the 2-year time period. And the second one is with regards to related party transactions. If you sell your relinquished property to a related party, and then you buy a replacement property, you're, with limited exception, required, each of you and the related party are required to hold the property for 2 years. So those are the 2 places where the regulations discuss the 2-year time period. And I think some people will kind of just blanket apply that 2-year period across the board, but that's really not accurate.
Okay, got it. Another question that I get a lot is, let's say, so this is another scenario that happens a lot, is like, I can think of like many scenarios off the top of my head already where someone bought a primary residence many decades ago. Maybe they're getting older or their life situation changed. They move to a new house or a condo, and then they say, I want to keep this single family as an investment property and rent it out. And they have so much equity, it's beyond the capital gain exception for primary owners beyond 500K, where we're talking about the gain being $1 million, maybe $2 million. I can think of multiple properties in Lexington that I rent that would fall in this category, for example. Is it possible to turn that primary property that has now become a rental single family into a 1031 candidate? And if so, is it the 2-year rule? Is it something else? How would that work, or is it not possible?
Yeah, it is possible, and it is that 2-year rule. So it's going to look at the previous 2 years. If it's been an investment property for the previous 2 years, then even though it was previously a primary residence, it still would qualify for a 1031 exchange. And we certainly run into this a lot, particularly, Boston, the greater Boston area, where some of the times people can buy a property and it can appreciate, many, many hundreds of thousands, where it's greater than the $250,000 or $500,000 primary residence exclusion. I do think it is kind of, with this subject, I think it's really important to understand kind of the tax deferral of a 1031 exchange versus the exclusion that you get under the primary residence exclusion. Particularly for somebody who kind of could have the option of utilizing both. Let's say they've owned they're within the 2 of the last 5 years of primary residence. So it's really important for somebody doing a 1031 exchange to understand that a 1031 exchange is not an elimination of gain, it's a deferral of gain. And the mechanism by which the gain is preserved, so to speak, within the property is through what's known as a carryover basis in the replacement property. So a very easy, simple example, let's say somebody sells a property for $500,000 and they have an adjusted cost basis of $250,000. When they do a 1031 exchange and they buy a property for $500,000, ignoring closing costs, their adjusted basis in that property is the $250,000 adjusted basis that they had in the property they sold. So they carry over that basis to the new property. If they then sell that, that replacement property that they purchased, that in a taxable sale, then that $250,000 gain is still going to be taxed. That's different than the exclusion that's available under Section 121, which is the primary residence exclusion. When you sell a primary residence and you qualify for the primary residence exclusion, there's an elimination of gain. So that gain is gone, never to be taxed again, within the limits of $250,000 to $500,000. So generally, if I'm speaking to a client who is kind of in a situation where it was a primary residence, but they're still within that, lived in it for 2 of the last 5 years, sometimes it does make sense to take the primary residence exclusion rather than doing a 1031 exchange, because a 1031 exchange does allow you to kind of defer the taxes, which has, a lot of benefits to it. But if you can get the exclusions, depending on your particular tax situation, it may be more beneficial to take the exclusion at that time.
Yeah, $500,000 in cash without any taxes is a pretty big deal.
Yeah, and going back to kind of what you said at the beginning, just to kind of emphasize that point, that's one of the reasons it's great to have a good CPA that you trust, who's knowledgeable, and they can kind of help you, because everybody's situation is different, and they can kind of help you run the numbers on those calculations to determine, what is going to be the most beneficial choice for you personally.
Yeah, that makes a lot of sense. And this is, and sorry for all the scenarios, but these are just things that I just hear every single year, and I know a lot of people ask them, so I just think it would be good to kind of address them. This is another really big one. The landlord owns one or a couple multifamilies, and they're like, Sage, I'm tired of being a landlord, but I don't want to take the hit on the capital gains and depreciation recapture. I've owned this 3-family for 30 years. I talked to my CPA. It's just too much. Is there a way that I can sell one or all of my investment properties, put them into a new property, and then at some point in the future, make this a vacation home for my family and enjoy the fruits of my labor, or make this maybe my primary residence in the future? Or maybe I want to move to Florida or California, or I want a Cape house, or I want a house in Maine. I've had a lot of these kind of conversations. Is that a possibility? And if it is, can you walk us through how that might look like?
Yeah, so that is a possibility, and particularly being located in the Northeast, that's something we see all the time.
Yeah.
There's probably some nominal percentage of our clients that are selling in, Massachusetts and buying properties in South Carolina, Florida, kind of escaping the cold weather that we're experiencing right now.
Hmm.
Um, and it really works no different than any other 1031 exchange, and it actually goes back to kind of what I explained earlier in the 2 years for the personal use. So a person can sell that three family that is rented full time to long term rentals, and they can acquire a property on the Cape or down in Florida that they use as a short term rental, Airbnb, what have you. And if they keep their personal use of that property to the limits, the 2 weeks a year, 10% of the time it's rented. Um, Following the 2 12-month periods following their acquisition of the property, they can then convert that property to a primary residence if they wanted to, or they could stop renting it and they can, exclusively use it as a vacation home. And there's really nothing that needs to be done mechanically at that point. Once they've reached that 2 year time period, it's kind of, we'll say the 1031 exchange has seasoned, so to speak, and the exchange is complete. Then they can convert it to a primary residence or a part-time vacation home, or what we would call a second home, I guess.
If that, I have a follow up question on that. If someone were to do this, and then let's say they say, you know what, I'm gonna move to Florida full time. I want to make this my primary residence. Would they then, at some point in the future, once they've lived there for the past 5 years, then be able to capture that $500,000 exception, or are there limitations because of the fact that it was previously acquired through the 1031 exchange process?
So they can still, so it's yes to both of those. They can still take the primary residence exclusion, but there is a certain amount that they can't take based on the ratio of how long the property was owned as investment property versus their overall ownership of the property.
Is that the full length of from the original three family in this example, or like how does? I'm just curious how that's calculated because I actually just don't. I haven't heard the answer to that before. Yeah.
Yeah, so to be honest, I don't know the calculation off the top of my head, but
Okay.
I believe it is. It doesn't go back looking to the previous property. I believe it looks the length of ownership of that specific property,
Okay.
and it's. I used to call it a proration, but it's really. I think a proration is the easiest way to understand it, but it's not. The way it operates isn't technically as a proration. I think there's a certain amount of the gain that you cannot exclude based on the mathematical formula that's in the regulations.
Interesting. Okay, that's a pretty. I mean, that's a pretty cool fact. That's really interesting.
Yeah,
Um,
that's one of those things where you want to go to your accountant and you want to say, okay, um, can you crunch the numbers on this? How much of the gain can I not exclude because this was previously an investment property?
yeah, that makes sense. Okay, that's really good. Another misconception that I think I get a lot is people make the assumption that if you're going to do a 1031 exchange, let's say you're selling a $1.5 million three family, a lot of people assume, well, if I'm going to do a 1031 exchange, the new property needs to be $1.5 million or greater. That's not actually true, is it? Can you explain maybe what happens if I do a 1031 exchange and the new property is less than the value of the property I'm selling, and then also if it's more than like the sort of the distinction there.
Sure. And I think that confusion probably comes from kind of what qualified intermediaries will generally refer to as like the rule of thumb or the napkin test. And that what that says is that in order to have a fully deferred 1031 exchange where you're not paying any capital gains tax, you need to acquire a property that's equal or greater in value, and you need to reinvest all the net proceeds from the sale of the property. Now, it's important to understand that that is only if you want to have a fully tax deferred exchange and pay no capital gains tax. If you buy a property of lesser value, or you don't reinvest all of the net proceeds, it's still a valid 1031 exchange, assuming you followed all the other necessary requirements. It's just there is going to be some tax consequences on that transaction. So you're not going to be deferring all of the gain. Now, you might be deferring a major portion of the gain, so it's still worthwhile. And it's a viable strategy for people to use. Let's say they have personal expenses that they need to cover, and they're getting a chunk of money from the sale of their property. It may be worthwhile for them to pay the tax on a portion of the gain to do whatever they have to do with it, whatever requirements they might have personally to use. How that might work, I'll kind of try and come up with an example with easy figures. Let's say you're selling a property for $1 million and you have a $500,000 adjusted basis, which would be $500,000 of gain. Kind of using simple numbers and kind of ignoring closing costs. Let's say instead you say, okay, well, I want to pull out some money, so you buy a property that's $750,000. Okay, well, you went from $1 million property to a property that's $750,000. So that delta, that $250,000, is going to be subject to tax. Now, if you kind of do the math on the sale, if they had just sold, not done a 1031 exchange, they would have to pay. They would have a taxable gain of $500,000. So by doing the 1031 exchange, even though they bought a property of lesser value, they're going to defer $250,000 and pay tax on $250,000. So that tax could be $70,000. So they saved themselves $70,000 in tax by doing a 1031 exchange, even though they might have to pay $70,000 in tax. Now, there does become a point where a 1031 exchange is not going to lead to a tax benefit. And it's always important that a client if they're planning on doing this, and many people will, they'll go into it saying, I want to take money out for whatever reason, and I know I have to pay tax on it, and that's a perfectly viable way to do a 1031 exchange. If somebody's in that situation, they should know kind of at what point it doesn't become worth it to do a 1031 exchange. And generally speaking, as long as you're buying a property that's greater or equal in value, well, I would say greater in value to your adjusted basis in the property you're selling, you're going to see some tax savings. Now, if your adjusted basis is $500,000 and you buy a property for $501,000, you're going to save one less dollar is going to be subject to tax. So that kind of sets up a continuum where, okay, zero tax benefit is at $500,000, where full deferral is $1 million in our previous example. And kind of where you buy along that continuum in terms of price kind of determines how much gain you're going to defer and how much tax you'll have to pay.
That makes sense. That's really helpful. To kind of shift gears, this is something I've heard a lot about, but I don't know of anyone who's done it, but I don't know the technical term, but I believe there is a way to do like a repair exchange where you can use some of the funds to do updates. I'd be curious to know the timeline, whether it's the same 45, 180, and sort of how that works and like how the funds are handled for the repairs and who's actually keeping track of this to make sure everything's kosher, basically, just seems like there's a little room for some gray area there a little bit. So I'm curious how that actually works.
Yeah, so those types of transactions, they can go by kind of a few different names. Sometimes they're called build-to-suit exchanges. Sometimes they're called construction exchanges. Sometimes they're called improvement exchanges. They work. I think they can be complex transactions. I think they in a lot of ways they work like a reverse exchange, where the qualified intermediary is parking and holding title to the replacement property, which is having the capital improvements, done to the property. And to give some background as to kind of why it is structured the way it's structured, a 1031 exchange, and we haven't referred to this at all throughout our discussion here, but sometimes it's referred to, and probably more commonly referred to, as a like-kind exchange. And the reason it's referred to as a like-kind exchange is because there is a requirement that you sell a piece of relinquished property and you have to purchase a like-kind replacement property. Now, the reason we haven't touched on it too much is because the like-kind requirement is actually very broad. So any type of real property is like-kind to any other type of real property. And to generalize that a bit more and kind of provide some examples, a multifamily is like kind to a single family home, is like kind to a piece of vacant land, is like kind to a commercial building, is like kind to a lease of 30 years or more. So it's very broad as to what's considered like kind, as long as it's considered a piece of real property. Mm-hmm. And that requirement is kind of the crux of why the improvement exchange structure exists. So as part of the 1031 exchange, the person doing the transaction has to acquire like-kind replacement property. The building, the improvements, the materials and services are not considered like-kind. So when they receive the property, the capital improvements have to be already done to the property. So kind of if you follow that through, okay, well, how does that occur? Mm-hmm. In some scenarios, you might have an accommodating seller. The buyer might say, okay, well, whatever, maybe it's a warehouse that they need to fit out for their needs. And they say, okay, well, we need X, Y, and Z done to the property. And the seller says, okay, well, let's, bump the purchase price up and I'll do the work. So when you get the property, then that work's done to it. That's probably a very rare scenario that's actually going to happen. Mm-hmm. So the improvement exchange structure kind of came up as a way to solve this problem. Mm-hmm. So what happens is at the purchase of the replacement property, similarly to in a replacement parked reverse exchange, the qualified intermediary is going to acquire title and park the replacement property. The qualified intermediary will act as the owner of the replacement property during the 180-day time period. And that 180-day time period is going to start from the date of the first transaction that comprises the improvement exchange. Because an improvement exchange can be structured as a forward exchange where you sell the relinquished property, you purchase land or building to have the capital that need the capital improvements done to them. And then that property becomes, is held by the qualified intermediary and is transferred back to the exchanger to complete the improvement exchange. Or it can be done as a reverse exchange where they acquire the land/building that they want to build on, and then they have the capital improvements done to those properties prior to selling the relinquished property. A scenario where you might...
It's only 180 days, though, to do the work. Is that right?
It is only 180 days, and that's kind of one of the biggest challenges in an improvement exchange is that time period. So let's say we're discussing a forward improvement exchange where they're going to sell first, then they're going to close on the then they're going to close on the purchase where the qualified intermediary is going to park title to the property. Then they have to do whatever work they can do to the property within the remaining 180-day time period, allowing enough time on the back end for the qualified intermediary to transfer the replacement property back to them. So it can be quite a tight timeline, depending on the nature of the capital improvements that are being done to the property. But we have done improvement exchanges. We've facilitated improvement exchanges where people have put up, nearly complete, homes within that 180-day time period. But it does require due diligence on the exchanger's part to make sure kind of permitting is lined up, contractors are lined up, and they say, okay, well, we got, excavators coming in on day one, and then framing crews coming in after the foundation is poured, and everything's lined up in a very kind of regimented fashion. A lot can be done, but it is a pretty restrictive time period.
But just so I understand this, to kind of stick with this for a second. So let's just to use another example. Let's say you have a 3-family, you sell it for $1.5 million. You acquire a 6-family for $1.7 million. And you're putting 25% down on this $1.7 million property, and then you use additional cash that you got from the sale of the property, and you decide to redo kitchens and bathrooms on the 6-family. You renovate it. As long as you get those kitchens and bathrooms done within the 180-day period, you are not paying any capital gains or depreciation or recapture in that scenario. Is that fair to say?
So, yes, assuming you follow where the qualified intermediary is going to acquire title of the replacement property and do the work. Now, I would say the scenario just to make sure I heard it correctly,
Yeah.
did you say the purchase was the sale was 1.5 and the purchase was 1.7?
Yeah, probably more likely be more, probably like maybe 2 million or 2 point
Sure.
whatever. Yeah.
Yeah. Okay. So generally speaking, in that scenario, it's I would generally not recommend doing an improvement exchange. So the scenario where an improvement exchange makes the most sense is if you, let's say you take, okay, well, they're selling for 1.5 and they're buying a replacement property for 1.2, and they need to spend $300,000
I
to
see.
get the added value so that the value of the replacement property becomes 1.5 once they're done with the
Or
capital
more.
improvement.
Yeah.
Or more, exactly.
I
Yeah.
see. Okay, that's actually really helpful because it's one that I haven't really seen that much, and that makes a lot of sense. Okay. Another question I get is like, I have a lot of people who are like, I've never done a flip before, Sage. I want to do a flip. You help me find a flip? I want to do, whether it's a quick flip, a cosmetic flip over a few months, or it's like they're going to do a total gut renovation over a year and a half. When it's done, can I then do a 1031 exchange? Can you answer that question? Because I get that one a lot as well.
Yeah, that's a common question we get asked as well.
Yeah.
And unfortunately, the answer to that is no. So,
Mhm.
the reason for that is it goes back to the property must be held for investment. And I think one of the challenging things with a 1031 exchange is, words don't always have the same definition when you're talking about, IRS laws and regulations than they would have kind of in normal parlance. So somebody might say, well, oh, well, the reason you can't do a flip is because a flip is not an investment property is not considered an investment property under Section 1031 of the Internal Revenue Code. And I think that's a difficult concept for some people to kind of understand. They say, well, what do you mean it's not an investment? I'm buying it to make money on it. But investment for the purposes of Section 1031 has a very specific meaning, and it's held for you can think of it held for long-term investment. And you're holding it for kind of like appreciation due to extrinsic factors. So you're not holding it for what you're doing. Okay, well, I'm buying a property, I'm adding value to the property, and then I'm selling it. Kind of your traditional flip scenario. And the reason for that is kind of a flip is considered inventory to a flipper. So inventory is not a capital asset. The sale of inventory is actually ordinary income.
Mm-hmm.
So somebody who's flipping property, like let's say that's their business, if they're flipping property, that's not actually a capital gain to them. That's ordinary income to them. Just like somebody who owns a store and sells widgets, their sale of the widgets is ordinary income.
Quick follow up on that. So I had during the period when interest rates were really low, there were a lot of people who wanted to get into flipping. Many that I work with or that I know, and many of them went in with the intention of doing a flip. But then what happened was when the property was ready, rates went up and their numbers no longer worked. And the result was they then had to rent these units. And they've rented them for the last couple of years. Maybe they've rented them for the last 2-3 years. Now, this year, I know of a couple developers that are likely going to be putting those properties back on the market. They've been rented, both units, for the last couple of years. Is that still considered inventory at that point? Or because the circumstances change, now would those potentially be opportunities for 1031? Or because the original intention was a flip, it's just off the table?
Yeah, I guess one of the things is because kind of your intent is a state of mind, you can change that intent. I think, and I'll kind of get into there are different considerations depending on each person's individual circumstances. So let's kind of take two different scenarios. Scenario one, we have individual A who bought one property to flip, and then for whatever reason, following the renovations, it didn't make sense to sell it or what have you, and they decided to rent the property for multiple years. They've been claiming the income on their tax return as rental income. Then absolutely that person could do a 1031 exchange, particularly if they're beyond that 2-year time period. I don't think there's any risk there. Now, kind of to what you said, okay, well, now I have a developer who is in the business of developing properties and selling properties. I think there it becomes a little less certain, and because a big thing is, you know, distinguishing an investor in real estate versus a developer or a dealer in real estate. And that becomes a much more kind of difficult question to answer. There is actually quite a few cases that kind of analyze this issue. So if you are somebody who has, you know, you do development as a business and you're, you know, developing and selling properties on a regular basis, I think you really need to make sure you have that good tax advisor who can kind of look at your particular scenario and determine if, okay, well, how have you treated that property on your tax return for the last 2 years? Has it been treated as, you know, an investment property? I think a lot of times kind of the gold standard, I would say, would be for kind of somebody who is a developer or a dealer to have different entities and keep, okay, here are my long-term hold entities. My assets that I'm holding long-term are an entity X. My dealer activities, my development activities are entity Y, so that you can keep those separate. Otherwise, there's a whole host of factors the IRS would look at for somebody who is kind of a dealer/developer to determine if that property might qualify as investment or if it's actually considered inventory. So it's much less of an easy question to answer and takes a much closer look at the actual facts and circumstances surrounding that individual when you're talking about somebody who kind of does this on a regular basis as a business.
That makes sense. And one thing that you said, that's very helpful, but you mentioned entities, and that's actually another question I get a lot is, my property's in an LLC, will that impact my ability to do a 1031? That's another common one I get. Does that have any bearing on the 1031 process, whether you can do it or not, or how you do it, the mechanics of the 1031?
Yeah, I will. Generally speaking, it will not impact whether you can or cannot do a 1031 exchange absent other factors. It does impact how the 1031 exchange is done. So for a 1031 exchange, there's what's known as the same taxpayer requirement. And what that says is the same person or entity that sells the relinquished property or owns the relinquished property must be the same person or entity that purchases the replacement property. So if you own it in an LLC, let's say that LLC is a multi-member LLC, so it's going to be taxed as a partnership, then that LLC has to acquire the replacement property.
Okay, that's really helpful. And I know we're running out of time here, so I'm going to just throw one more question at you, and then I'll let you go. You've been really awesome. I think the last one I just want to end on that I get all the time is like around inheritance. And it's sometimes it'll be, you know, this individual inherited this property from my parents, and then other times it'll be me and my siblings inherited a multifamily property. Maybe they all want to do a 1031 together, or oftentimes there's one person who has a dream of now starting a real estate empire or doing something with that and going off, and other siblings say, I just want the money. Can you talk through a little bit about inheritance in 1031 exchanges?
Yeah, I think first and foremost, somebody who inherits a property, you know, the question is, okay, did they receive a step up in basis in that property? So if they did receive a step up in basis, that step up in basis is going to be based on the fair market value at the time of death. So whether it's even worthwhile for somebody who has inherited a property to do a 1031 exchange is really going to be determined by, you know, what was the fair market, you know, what was their step up in basis and how long has it been since they received that step up in basis? Because the step up in basis is the fair market value at the time of death. However, let's say, you know, property has appreciated in value since they've owned it, however long that may be, then it becomes kind of viable for them to do a 1031 exchange. Now, when you get into kind of joint owners, it gets a little bit more complex depending on how they inherited the property. Kind of the easiest scenario is we're all individually, you know, tenants in common on the property. If they've kind of been owning and operating it as tenants in common and they have not this is a little bit more of a complex concept, they haven't formed a de facto partnership during their ownership of the property, then it's pretty easy. As tenants in common, they can each choose to do or not to do a 1031 exchange as they wish. So they can sell the property, and let's say it's siblings A, B, and C. Siblings A and B can take their cash and pay the tax on it, and sibling C can then have the option of doing a 1031 exchange and deferring the gain. It can get a little more complex depending on the type of entity that the property is held in. If it's held in a trust, then you have to go back to the same taxpayer requirement that I kind of briefly touched on earlier and kind of look at, okay, well, is it a grantor trust, or is it a revocable or an irrevocable trust? And that will kind of dictate kind of what steps have to be followed to properly do a 1031 exchange. In most, if not all cases, it is going to be possible to do a 1031 exchange. It's just going to require some pre-planning in order to make sure it's done properly.
Awesome. Well, Al, you've been awesome. I feel like this has been, I've tried to teach myself a lot of stuff by going to other talks that you've been to and many other things online, but I feel like this has been super valuable. I think the viewers are going to really appreciate this one. In the description, I'll definitely include your email and phone number and website so people can reach out to you directly if they'd like to go through the 1031 process. Do you have anything else, any other information you want to share before we kind of part ways?
No. So kind of one of the things kind of you had mentioned is kind of what kind of pitfalls people should watch out for.
Yeah.
And I think that would be a good one to touch on. I kind of gave some thought to that.
Yeah, please.
And I think the first and foremost is the 45-day time period, but we kind of covered that. Another one I think is, really when you're doing a 1031 exchange, no matter what qualified intermediary you use, make sure you're in contact with that qualified intermediary and giving them kind of a thorough description of what you're planning on doing with your 1031 exchange. What are your thoughts? Reach out to them, let them know kind of what you're planning on doing, because part of the role of the qualified intermediary is to kind of troubleshoot these transactions and to make sure they're compliant with the IRS regulations. So you want to make sure that you're keeping the qualified intermediary in the loop. So just kind of one little piece of advice on the outgoing end here. Make sure you're speaking to your qualified intermediary and make sure you're kind of keeping them informed about what your plans are. They can catch a lot of potential issues before they become issues and kind of make it a whole lot easier of a process.
Yeah, and I have a feeling you're saying that based on personal experience where people can be out of the loop, and then it's, oh, we already sold the property, or oh, actually, we're doing this. And you say, whoa, 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 wait a second. We need to have a conversation. I have a hunch that's happened many a time.
Yeah. Unfortunately, I will say it's not uncommon. So it's always a good thing. Make sure you kind of keep your qualified intermediary in the loop and just kind of, run it by them, see if they have any thoughts or concerns. I'm always available to my clients. I'm always happy to sit down with them, on the phone or even in person and just kind of talk through what their plans are to make sure that they're kind of making the best use of the 1031 exchange.
Well, thank you, Al. I think you're the best. You're the only person that I go to whenever I do a 1031 with any of my investor clients around Cambridge, Somerville, and beyond. So I really appreciate your time, Al. Again, we'll include your contact details in the description. So if anyone's interested in reaching out, they certainly can. And thanks again.